GES Financial Services offers you one of the most successful roads to accumulate money tax-free during retirement. We have a threefold objective: increase income, reduce taxes, build wealth. We should avoid the following risks: inflation, income taxes, lack of diversification, living longer than expected, and most importantly, major market downturns. Of course, it's not a question of if the market will crash again. It's just a matter of when. What are you looking for in a retirement plan? Guarantee of safety, tax-deferred growth, fair competitive yields, liquidity, an investment vehicle that has always been safe, even during the Great Depression? Will Rogers once said, "I'm more concerned about the return of my investment than the return on my investment." Let me share with you the story of Columbus that demonstrates the value of compound interest and tax deferral. He had $1 to invest in 1492. He invested it at 5% simple interest. Today that dollar would be worth just $26. So let's take a look at an alternative. Now he gets 5% compound interest, but with a 36% income tax each year. Today that dollar would be worth $6,900. What if Columbus had 5% compound interest with a 36% income tax, but he could defer the taxes until withdrawn? Today that dollar would be worth $39 billion. Which is the vehicle that will provide all of the following: guarantee of safety, tax-deferred growth, fair competitive yields, liquidity, can be indexed to the stock market without downside risk? There's even more: avoids probate, provides a guaranteed income that cannot be outlived, can reduce or eliminate Social Security tax, can be exchanged for a like plan without creating a taxable event, and, very importantly, protected from creditors. Is it a bank CD, bonds, mutual funds, individual stocks? No, it's a tax-deferred equity indexed annuity. The Honorable John E. Chopton, Assistant U.S. Treasury Secretary for Tax Policy, once said, "To the extent that annuities can be fashioned to offer interest rates that are competitive with rates paid by other financial instruments, there is little reason why a potential investor should purchase anything but a deferred annuity." It is so important to recognize the power of no downside risk in an equity indexed annuity. The question always seems to be, is it a bull or a bear market? Let's take a look at the S&P 500 index between 2007 and 2012. Let's suppose this person has $100,000 in the S&P 500 in 2007. Because of the market loss in 2008, he lost 38% of his investment, so that in 2012, his account value would be just $88,275, in spite of significant increases in the following years. If that downturn happened just at the time of retirement, it would be extremely unfortunate. Now let's compare the S&P 500 to an equity indexed annuity during the same time period. In the equity indexed annuity, there is no loss during the market downturn. Now that $100,000 investment in 2007 would be $119,150 in 2012. That's almost a $32,000 difference. This chart compares the S&P 500 to the equity indexed annuity over 20 years. In 2008, for example, When the market took a major downturn, the equity indexed annuity remained the same, resulting in an almost $65,000 advantage for the equity indexed annuity. If you would like to find out how an equity indexed annuity can work to your advantage, please contact Gary Smith at GES Financial Services, 408-314-8858, or see our website at gesfinancialservices.com.